The Dow's surge notwithstanding, there still exists a cottage industry of quote-unquote perma-bears, people who refuse to believe the U.S. economy is, in fact, on the mend. One of those is NYU professor Nouriel Roubini. He was on Squawk Box this morning. Here's what he had to say.
I see two risks that may lead to a double dip. The first one is we have very large budget deficits that are being monetized by the Fed. At some point, the bond market, especially next year, might worry about these large fiscal deficits. Two, oil prices have already gone from 30 to 70 in a situation in which demand is back to 2005 level and inventories are high.
Joining us now, Peter Schiff. He is the president and chief global strategist of Euro Pacific Capital and the author of Crash Proof. He has also been the voice of pessimism well before the market blew up, with the Dow surging again today off the Fed's announcement. Is this perma-bear finally ready to go into hibernation? It's time to play our favorite game here on the desk, bull market or BS. Peter, welcome back.
Well, thanks for having me. You know, I'm not a perma-bear. I've just been bearish for a while.
For a really long time.
Well, but for the right reasons. I mean, being bearish has been the right thing to do. But at the same time, I've been bullish on other parts of the world, and I've been investing accordingly.
So, Pete, that's a great point you just make. You've been bullish on other parts of the world, and you've done well in those other parts of the world. You've avoided the U.S., but the U.S. has done well. But at what point do you step in and say, you know what, I'm all in on the short side here in the S&P? At some point, it has to be attractive for somebody like you.
I'm not short anything, so I'm not all in. But, I mean, I'm out of the dollar. I understand that, you know, we're in trouble economically. The reason we got into trouble is because of all the mistakes that Greenspan made and all the mistakes that Bush and Congress made. Well, everything that we've done under Bernanke and what we've done over Obama is worse. We're making even worse mistakes now than we made in the past. So the consequences are going to be more disastrous for our economy and for our market.
Right. So my question to you is, Pete, at some point, though, the S&P has to be I'm not saying you're all in short here. I'm saying at some point, though, it has to be an attractive trade for you to be short the S&P. Are we close, or are you just avoiding it entirely?
I don't know. I'd rather be short the dollar, which I am. The thing is, if you have a very weak dollar, if you have an inflationary environment, it's possible for U.S. stock prices to rise rather substantially in nominal terms, but still lose value in real terms. And so if you're simply shorting U.S. stocks, if the dollar goes down more than the stocks that you're shorting, you can end up losing. I think it's better to invest abroad, to take a look at the opportunities that exist outside the United States, and to own those assets, to invest in companies where their central banks are not making as enormous as the mistakes that we are, and where basically the fundamentals of their economy are sound. They're not living in an illusion.
What's it going to take for you to become more bullish about the U.S. stock market specifically? I understand you're short the dollar, but when it comes to the stock market, when are you going to change your sentiment?
Well, first of all, I'd like to see the government reverse course. I'd like to change the policies. Instead of continuing to make the market problems worse, let's create a foundation where the economy, where the free market can make the problems better. So instead of having, easy out, your show is fast money, but Ben Bernanke, his show is all about loose money. We need to put that to an end. We need to raise interest rates. We need a realistic interest rate in this country. And I know he's saying that he's not going to buy treasuries anymore. He's not telling the truth. The Fed is going to keep on monetizing this debt.
Peter, go back to March then. The market has improved significantly. We rallied 50%. The economy has obviously improved if you look at the numbers. What has Bernanke done that is incorrect? Because if you look at the policy in supporting risky assets and actually purchasing risky assets in a deflationary environment, that was the right thing to do.
No, it wasn't the right thing to do.
The market's telling you that it was.
No, the market goes up and down. It doesn't tell you anything.
The market's not going up and down. The market's going straight up.
No, it went down first, and now it's going up. Maybe it'll go down again.
After Bernanke on March 18th came in and supported risky asset purchases.
But he shouldn't have done that. And the economy has not improved.
Then where would we be?
No. We would be trillions of dollars less in debt. We have dug ourselves into a deeper hole under Ben Bernanke. Ben Bernanke's policies have helped prevent the economy from correcting the imbalances that led to the problem. We need less consumer spending, dramatically. We need less borrowing. We need to make more things. We need to save our money, and the government is undermining that progress. And what we need is to allow the government to shrink. And by buying all this government debt, by keeping interest rates low, he's let Congress off the hook. Instead of contracting government spending, he's monetized it all. He's made it possible for the government to expand. He should be reining in the government. He should be taking away their punch bowl. He should be aggressively maintaining sound money and higher interest rates and forcing the government to cut spending and reining in all these excesses.
Right. Peter, great to talk to you. Always good to have your insight, Peter Schiff of Euro Pacific Capital. Karen, What do you think of Peter's arguments?
Well, I clearly a smart guy.
Yeah.
I think, though, that I agree with Joe in that something had to be done. We really were on the precipice of an absolute financial collapse. So I think a lot of what Bernanke did makes sense to me. I do think he's going to be able to pull it in a little bit.
And why does he have to pull it in today? I mean, I think you allow Mr. Bernanke to continue this policy, and then when the time is right, that's when you move. I think Goldman Sachs, when they basically called a bottom just a couple of months ago in multiple sectors, and all we've done is go higher, they basically were talking about the consumer and the comeback, industrials. And you take a look at a lot of those various stocks, they have done nothing but start to improve. Once they've got past the point, then that's the time for them to start moving.
There are many ways to pull it back. I mean, it's not just raising interest rates. They can raise a reserve rate, for instance, and get banks to lend back to the government.
His head right now. It's just like,
that's why he told me to go away.
Plenty of ways to pull it back, and everything that they have done have improved the economy, have improved the markets, and we sit right now at 1,000. And it is the sentiment that Peter portrays, and he's a brilliant guy, but the sentiment that he brings is one of the reasons why the market's not going down, because no one believes the move.